This is the High Voltage Business Builders Podcast, daily intelligence for serious e-commerce portfolio builders across Amazon, TikTok Shop, Shopify, Walmart, and every channel that moves the needle. Neil Twa and his Voltage team all day, every day since 2012. Let's get into it.
Amazon just dropped its Q1 2026 earnings report, and buried inside the numbers is something every FBA seller needs to understand, whether you're doing $3,000 a month or $3 million. Here's the headline. Amazon's North America retail segment grew. Again, ad revenue climbed, AWS carried the margin, and fulfillment costs, the ones that come directly out of your pocket, continued to rise faster than the revenue growth that's supposed to offset them. If you're a seller doing $10,000 to $30,000 a month, you felt this before the report came out. Your fee notices hit your seller dashboard, your storage costs crept up, your PPC bids got more expensive because more sellers are competing for the same eyeballs. You're working harder for the same margins you had 18 months ago. If you're doing $500,000 a month or more, the earnings report tells you something different. Amazon is doubling down on advertising as a profit center. That means the platform is structurally shifting toward pay-to-play at every level. The organic lift that used to subsidize new brands is compressing. What does that actually mean for your business this week? It means the sellers who treat this as a passive listing game are going to feel the squeeze first, and the sellers who understand what Amazon is optimizing for and align their brand strategy with it are the ones who will grow into the second half of 2026 with real margin intact. The Q1 numbers are a signal, not just a scorecard. Amazon told you exactly what they're prioritizing. The question is whether you're positioned to benefit from it or get squeezed by it. Let's break down what those numbers actually mean for your business. Amazon's Q1 2026 earnings revealed three things that matter directly to FBA sellers. First, advertising revenue grew significantly, outpacing overall retail growth. That's not a coincidence. Amazon has been engineering its platform to monetize attention more aggressively. Sponsored products, sponsored brands, and DSP are no longer optional amplifiers. For most categories, they are the discovery layer. If you're spending $1,500 a month on ads and your ACoS is drifting up, this is why. The auction floor is rising because Amazon is incentivizing more sellers to bid. Second, fulfillment and logistics costs as a percentage of revenue stayed elevated. Amazon has been investing heavily in its same-day and next-day infrastructure. That investment doesn't come free. It gets passed through to sellers in the form of FBA fee increases, surcharges, and inbound placement fees that launched in 2024 and are now fully baked into your cost structure. If you haven't rebuilt your unit economics model in the last 6 months, your margin math is wrong. Third, third-party seller services, the bucket that includes FBA fees, referral fees, and fulfillment revenue from sellers like you, grew faster than first-party retail. Amazon is leaning into the marketplace model. That's good news for sellers in one sense. Amazon needs you, but it also means Amazon will continue extracting more value from the relationship over time. Here's what this means at the practical level. If you're selling a product with a $25 retail price and a $9 landed cost, your FBA fees plus ad spend may now consume $12 to $14 of that $25. That leaves you $1 to $4 before returns, storage, and overhead. That's not a business. That's a break-even experiment. The sellers who survive this environment are the ones who either move up in price point, reduce their cost of goods, or find categories where ad competition hasn't fully caught up yet. Let me give you two sellers. Same platform, same quarter, very different outcomes. First seller, Marcus. He runs a home organization brand on Amazon. He's been at it for about 2 years, doing roughly $40,000 to $60,000 a month in revenue. When the inbound placement fee changes rolled out in 2024, he absorbed them without adjusting his pricing. When his PPC costs climbed through early 2026, he kept his bids roughly the same and watched his conversion rate slowly erode. By the time Q1 2026 closed, his effective margin had dropped from about 22% to just under 11%. He didn't change anything. The platform changed around him. Second seller, Diane. She runs a kitchen accessories brand. Similar revenue range. She was doing about $55,000 a month entering Q1 2026. When she saw the same fee pressures, she did three things. She audited every SKU for true landed margin, including all fees. She cut the bottom 20% of her catalog, the SKUs that looked like revenue but were actually diluting her cash flow, and she raised prices on her top 3 ASINs by $3 to $5 each, testing the elasticity first. Her revenue dipped slightly in February. By March, it had recovered, and her margin was back above 24%. Same platform, same fee environment, same ad market. Completely different outcomes based on one thing. Diane treated the earnings signal as an operator decision, not background noise. This is what sellers who survive platform changes do differently. They don't wait for their margin to disappear before they act. They read the signal, audit the numbers, and make the adjustment before the quarter closes on them. 3 moves. Do these this week. Move 1. Rebuild your unit economics from scratch. Not from memory, not from last year's spreadsheet. Pull your actual FBA fee totals from the last 90 days. Add your average ad spend per unit sold. Add your landed cost, including freight and prep. Subtract from your average selling price. What's left is your real margin, not the one you estimated when you launched the product. If you're doing $5,000 a month, do this for your top 3 ASINs. If you're doing $500,000 a month, do this across every SKU tier. You cannot manage what you haven't measured accurately. Move 2. Test a price increase on your best performing ASIN. Amazon's Q1 data tells us that consumer spending on the platform remained resilient even as fees rose. That means price elasticity in many categories is better than sellers assume. Pick your top ASIN. Raise the price by $2 to $4. Run it for 14 days. Watch conversion rate. If it holds within 5% of your baseline, you just recovered margin without touching your cost structure. Small sellers can do this tomorrow. Larger operators should be running this test across multiple SKUs simultaneously. Move 3. Audit your ad spend for dead weight. Pull your search term report. Sort by spend. Find the terms that have consumed more than $50 over the last 30 days with 0 conversions. Negative match them today. If you're spending $2,000 a month on ads, there's almost certainly $300 to $500 being wasted on irrelevant traffic. Recapturing that spend and redirecting it to converting terms will improve both your ACoS and your effective margin without increasing your total ad budget. 3 moves. Real margin impact. Executable this week, regardless of where you are in the business. Here's the honest truth about Q1 2026 earnings. Amazon is not slowing down. The platform is not getting cheaper. The fee environment is not going to reverse. And the sellers who are still treating this like 2019, list a product, run some ads, collect the check, are going to find themselves squeezed out over the next 12 to 18 months. But the sellers who understand what Amazon is actually optimizing for, they're going to have one of the best years they've ever had, because when competitors exit, the shelf space opens up. When ad costs scare off undercapitalized sellers, the auction gets cheaper for disciplined operators. Every platform shift creates losers and winners. The difference is preparation and execution. That's what we've been doing for 13 years at Voltage. Not theory, not a course, actual operator-led brand building, from product selection through exit. We've worked with sellers at every level, from people launching their first product with $10,000 to $15,000 in starting capital, to operators managing catalogs doing millions of dollars a year. The approach is the same. Build real margin. Build real brand equity. Build a business that survives platform changes because it's not dependent on any single lever. If you want to understand where your business actually stands heading into Q2 2026, not where you hope it stands, come talk to us. There's a link in the show notes. One conversation, no pitch, just an honest look at your numbers and what the path forward looks like. You've been listening to the High Voltage Business Builders podcast. The platform changed again this quarter. The question is whether you did too. That's a wrap on today's episode. If you're trying to figure out where AI actually fits in your business and where to invest before bolting it on top, head over to voltagedm.com/AI quiz. 5 questions, 60 seconds, a personalized AI readiness score, and an instant foundation gap report. Built for operators, not AI tourists. We'll be back tomorrow with another edge. Until then, stay high voltage.